On behalf of the Faculty of Economics, it's my great pleasure to welcome all of you to our first ever Cambridge Connections Distinguished Alumni event. My name is Meredith Crowley. For anyone who hasn't yet met me in class, I'm a professor of international economics, and I'm also the Director of Development and Alumni Relations in the faculty. Tonight, we're very pleased to bring you an evening with Mr. Charlie Nunn, one of our distinguished graduates. Charlie is Executive Director and Group Chief Executive of Lloyds Banking Group. Prior to joining the group, Charlie held a range of leadership positions at HSBC, including Global Chief Executive, Wealth and Personal Banking, Group Head of Wealth Management and Digital, and Global Chief Operating Officer of Retail Banking and Wealth Management. Charlie began his career at Accenture, where he worked for 13 years in the US, France, Switzerland, and the UK, before being made partner. From there, he moved on to McKinsey, where as a senior partner, he led projects for 5 years. The faculty's Julian Lorcan is here tonight to lead us in a conversation with Charlie. We're going to be recording the discussion as well as the Q&A following the event. Just in advance, I want to say thank you to everyone who submitted questions ahead of time. There were a ton of them, and so I'm really excited to see all the enthusiasm from all of you. And the video is going to be available on the faculty website later in the term, so if you have friends who wanted to be here and couldn't, please go ahead and share it with them. And without further ado, I'll hand over to Julian.
Thank you very much, Meredith. And indeed, as Meredith explained, Charlie Nunn, he's got over 25 years of experience in the financial services sector. He studied, like many of you, in the Faculty of Economics over a quarter or a century ago. Now, of course, Chief Executive of Lloyds Banking Group, that we know through their high street banking, through Halifax, Bank of Scotland, various other banks that they've got within their group. Now, Charlie, it's absolutely fantastic that you're here. It really must actually take you back, being around here in Cambridge. Remind us exactly what you studied and exactly when you studied, if you can.
Yeah, well, thank you, and thank you for being here. I can't believe you're all here on week 5, I think, of your term. And I'm not sure I live up to distinguished alumni, but we'll go with that for now. I studied at Cambridge in 91 to 93, and I studied economics, and I was just catching up. It sounds like the economics Tripos at that stage was very similar. It was about 150 people, about 70% British, 30% international. And I think I can say it in this environment. I normally am careful at dinner parties, but I love economics. I loved what I did then, and I still love what I do now, and I use the economics Tripos every day.
So what were your fondest memories then? You say it's great to be back here, but what are your fondest memories both of the faculty, of the teaching you received here, and come to that of your college as well?
Well, thanks. I was going to say, so I will get to the faculty. My fondest memories had nothing to do with learning. I was into sport. I met my future wife here, and I had a lot of fun outside of learning. We were just talking about it. Interestingly, the two things that were most useful, which is a terrible assassination of the rest of the economics Tripos, was game theory, and I don't know if you still teach transactional economics, COS. No, everyone's looking at me blankly. We do. Transactional economics, which if you take the lens of digital and digital transformation and then big data, the unbundling of the way the theory of the firm, individuals and economies work. What I've done for the last 30 years is use digital and data to unbundle and reform the way organizations work, and COS was the closest thing to that, interestingly. So those two things, transactional economics and econometrics. And then, interestingly at the time, I was not a huge fan of macroeconomics, but today I get pulled into it every day, working with the governor of the Bank of England and the government.
Great, and how about your time in college as well? Taking us away from the faculty for a moment, which college were you?
I was at Downing. I really didn't deserve to be at Cambridge because I was just at a local state school down south. I had a very, very poor predictions. I took a year off, went travelling, and my mum's boyfriend at the time said I'd got good results and I should apply. And so I picked my college based on which college was good at sports, and still had a nice look in the pictures. And I remember I applied at the time. It's still presumably the same. You could choose 3 colleges, and I wrote on my first choice Downing College, and I then put below it, I crossed out 2 and 3 and just said not interested. Which I mean, what a stupid thing to do. Anyway, my mum actually produced this application form for me about 3 or 4 years ago, so I've still got that paper form saying that. So I was at Downing, and I'd never rowed before, I ended up rowing. I was the honorary secretary of the Cambridge University Boat Club, which is probably the best title I've ever had. I think what it really meant is I couldn't get into the blue boat, so they gave me a different title. So I did a lot of rowing, did a lot of cycling, and did a lot of meeting friends and having fun. It was good.
Well, I'll pick up on the macroeconomics that you briefly mentioned there a little bit later, but I'm going to wind you back a little bit, if you like, because you're from the same part of the rural Hampshire countryside as me. And when I was there and look at universities, Cambridge always seemed very aspirational, just something you might be able to get into. How important was having that Cambridge education, and particularly the Cambridge difference, just a slightly different way we've got of teaching people in Cambridge, and come to that, the collegiate system. Danielle actually asks, and it's great that we've got so many questions from the floor, she emailed it in and said, how much of an advantage was that Cambridge education when it came to job hunting?
So it's really interesting. It was an advantage. And I didn't realise at the time, as I said, I went to a local school and there was no career advice and no one had ever been to Oxford or Cambridge. And so I didn't realise what I was doing when I applied here. And I'll tell you in a second some of the advantages it gave me. It was a real advantage in my early career. And I think that's fantastic at one level. Now in my role, I'm spending a lot of time though making sure we're more inclusive in terms of how we do our hiring practices, because Oxford and Cambridge is fantastic, but it ends up excluding so much talent from the UK and other parts of the world that I'm trying to build ways of engaging talent much more broadly and more inclusively than looking at Oxbridge. But to give it to you very clearly, the first 2 consulting firms I joined, and actually McKinsey's, at the time I joined McKinsey's, it only accepted talent from Oxford and Cambridge in the UK. Now, the UK wasn't the biggest source of talent for McKinsey's, but in the US it was really only Ivy League colleagues, and then from MBAs it was 3 MBA schools in the world. It was Harvard, Stanford, and INSEAD actually. So the reality is I wouldn't have in the 90s and in the 2000s got the jobs I got without coming to Cambridge. I hope that's not the case. Now, you're all fine, by the way, so you're here. So wonderful, and it makes a difference. I think society was a bit too narrow in terms of how they thought of where talent is and how talent has had opportunity in their younger careers, but it was a wonderful door opener. The more important part I think you just touched on is the method of learning and teaching at Cambridge. I see a massive difference from graduates today even that go through the Cambridge way of learning, and especially the supervisions and the opportunity to really debate and have discussions. I don't know if you like those or not. I'm argumentative, so I love them. But you have a much higher confidence from students that go through that kind of learning process to debate real issues and take a point of view and take a position. And I do still see there's a few universities in the country and then globally that have that as a basis for how they do their learning. That makes a difference. And
I'd much rather have somebody who may disagree with me but can argue eloquently for their point of view. And in fact, a little bit later on, I'll come to some of those issues with Lloyds. But I'll go back again to your career and really getting your first foot on the banking ladder and having that door open for you so you get to the stage of having a job interview. This is relevant, I think, for many people in this room, particularly for the next few years. And Izzy asks, and almost a bit of a statement, but says, why do so many people from the faculty seem to thrive in the square mile when a few years after graduation? But really, how do you get there? If you're going to be knocking on doors in the next year or two and you're going to be thinking, I want a career in banking, what do you do to impress the hiring manager?
Yes. So let me be honest, first of all, about my career, because I ended up in banking because I was passionate about 3 things. Economics and financial services, and I'm sure we'll get to why I believe financial services matters, and it really does. It enables most Western and economic systems to work. I was really passionate about technology and the role it had in shaping the future of the world, and I wanted to see the world. I'd never flown outside of the UK before I earned my own money and started flying myself. And those 3 passions, I left my economics tripos and I was trying to work out where I wanted to go. I actually initially went into the trading floors on the back of an econometric piece of work I'd been doing. I'd helped the Bank of England do some modelling around the way the transmission mechanism works in my summer placement, and I'd worked at Salomons, which doesn't exist anymore, but for those that read Liar's Poker, which was about the terrible, terrible behavior in the late 1980s and early 1990s on the trading floors. I went and spent 6 months modeling the US dollar yen exchange rate as an extension of a summer placement. And I decided I hated the culture on the trading floors. So I then thought, what can I do? Didn't know what I wanted to do, and thought, if I join consulting, I get to change the world with technology, I get to serve every sector in the world, and I can go and work in any country in the world. And that's why I joined what was called Anderson Consulting at that stage, but Accenture. Now, how did I do that? I think everyone I know that's got on and done things they've been passionate about has failed at virtually every step at least once, if not multiple times. And certainly I applied to every consultancy on the planet. When I looked at Accenture, I had a really clear vision in my mind for the kind of firm I wanted to join, and I just started getting no's for many of them. I actually applied to McKinsey's back in 1993, and they said not a chance. And then I rejected them after my MBA, which made me feel a lot better. I literally researched where I wanted to go, started the application process, and like everything else in life, it was the first sets of interviews that I learned how to interview. And by getting rejected, I learned how to be better at representing myself and working out what I wanted to do. And I can't remember how many times I'd applied for roles until I got Accenture, but it must have been the 4th or 5th job I'd applied for. The really interesting thing, though, when you get in any organization, you have to have a really clear view around what you want to get out of it, because no organization is going to help you. So getting the first job isn't the fun bit. Working out how you really take advantage of your organization is where you can have a brilliant experience or you can have a pretty dull experience. And I decided I wanted to go and work in different countries around the world. I wanted to work in different areas in financial services. I wanted to go and see the best tech companies. I ended up in San Francisco for 5 years during the dot-com boom. I worked on the trading floors of New York, Singapore, Frankfurt and Zurich, because that's where they were in Switzerland, in Europe at that time. And whatever organization you need to get into, I think it's what you do next that makes your career more fun and your learning better.
But for those people who are looking at, say, a career in banking, and certainly when I graduated in the early 1990s, I was looking maybe square mile, career in banking, and being brutally honest, it was a bunch of old blokes in suits in those days, and I just thought, I really don't want to particularly work there. What do you say to those people who maybe have looked at a career in banking and are going, oh no, actually maybe it's not for me?
Yeah, I mean, like everything, I think you definitely have to go and meet different organizations and go and suck it and see, go and test it. There's definitely, and we'll talk, I'm sure, about inclusion and diversity, and I'll tell you about what I'm trying to do at Lloyds Banking Group. There's definitely still parts of financial services which aren't as strong as they should be from a gender diversity and from an ethnicity. Actually, when you think about broader cultural diversity and then backgrounds, financial services is quite mature. And put it another way, you can go and join the best financial services organisations in the City of London, and you'll find very few British people there. My last management team at HSBC, I was the only British person. I had 140,000 people. My direct reports was about 15 or 20, and I was the only English person in the team. So there's massive diversity. What's developing and what's getting, we're having to really drive the pace on is seniority around female gender diversity. And then in terms of ethnicity, actually, most of the ethnicities are well represented in financial services. Black heritage isn't. And that's true in the UK. I've run businesses in the UK, US, France, and Canada, which have got the highest percentages of black heritage people in society. 13% in the US, 7% in Canada and France, 3% here. And even in the US, less than 1% of senior executives in financial services have black heritage, which is the most where society has up to 13%. So there really is a lack of diversity, and that's a real priority, certainly for me, and I can talk about that, but financial services. When I joined in the 90s, it was the most toxic and least inclusive environment I've ever worked in. And I think that's what you're talking about. And the trading floors of the 1990s were horrendous. In 1999, after my MBA, I went to San Francisco. And I don't know if there's any Americans here or people that have worked in San Francisco or California, but it had a culture of being the most politically correct environment in the world. And so I went from the trading floors of London and New York, which are the most toxic environments I'd ever been, into the most politically correct environment I've ever worked in. And they labeled me the walking lawsuit within about a week, because we found out I didn't have a single joke. I like to tell jokes to my teams. I didn't have a single joke that worked for Californian culture in 1999. So yeah, there were parts of the city in the 1990s that I really wouldn't recommend. It's evolved and changed a lot. There are organizations that are completely committed now to a different way of working. And just to give you a feeling, this isn't about Lloyds, but as a large financial services, we employ 70,000 people in the UK. I've made a public commitment to have 50% gender diversity, and then Black, Asian, minority, and ethnic, which I know is not an acronym people will necessarily like, which is about 13.5% representation in the UK. We've committed to Black, Asian, minority, and ethnic representation of 13.5%, and then I've committed to 3% of my senior leadership being Black. I've taken, since I've been there, my direct reports, I had one woman reporting to me. I'll have 47% of my top team is now women, and 15% is from an ethnic minority. So within 12 to 14 months, you can make a difference. And I've made public commitments, which I'm reporting on all of those ethnicity and diversity targets. And we'll get there, because we'll be a better, fitter organization, we'll serve our customers better, and bluntly, it'll be a much more fun place to live and work.
Absolutely, and I'm sure many people probably in this room will be looking in the next few years for a fun place to work as well as somewhere to work. We'll come on to work-life balance in just a moment, but really for those people who are looking at graduating maybe next year and have immersed themselves in the economics faculty here, many of you have done very, very well. You really got really all that understanding of the economic theory. But then you go out into the real world, and I've got two questions actually from the floor. Quirian questions how relevant the economic theory that we're teaching is to the real world, and equally Jigwen as well, a very pertinent question of when you first start a job, you may have been immersed in a university for 3-4 years. How do you actually get yourself match fit, work ready, so you can actually work properly in that organisation on the first day in the job?
Two really different questions. I'll be a bit quick. Just on the first one, I said up front, it may be me because I'm dull, but I use what I learnt here and through my MBA virtually every day. Now that's linked to the nature of my role. But even on my first day at work, I told you what I was doing. I was doing econometric modelling between the US and Japan back in 1994. There was a dislocation in the exchange rates. No one understood why. It had historically been linked to the balance of trade. You can see where this goes. This is all now joining up our economic theory. And we were investing at that time. It seemed like a lot. It wasn't very much. They were doing about 10 billion of proprietary investing that was exposed to that currency exchange. So this was a big issue for Salomon Smith Barney at that stage, or Salomons. So on day one, I was using econometric modeling, trying to use the theory of macro theory and trade to understand why there was an imbalance. That was very specific. But literally, all the way through my career, different parts of what I learned here have been relevant. Of course, I've always thought economics is more than anything a way of thinking about problems and a way of breaking down problems to an overly simplified view of the world, so you can then build it back up into reality. And that's been probably the most powerful part of how you think about problems and then how you break them down and lead them in a real world where the complexity can stop you making decisions. And I said earlier, game theory and then COAST, but transactional economics, but really thinking about reconstructing value chains and business models has been at the heart of what I've done. And then macroeconomic theory. Fortunately in my role, so Lloyds Banking Group has 15 to 30% of all savings, investments, borrowing in the UK economy. We issue 30% of gilts and we process 30% of payments in the UK. So there isn't anything that happens in the UK economy without Lloyds Banking Group, and if Lloyds Banking Group fails, it would bring down the UK economy. So I'm in the middle of the discussions with the Treasury and the Bank of England around monetary policy, trying to help them understand what the transmission mechanisms are. I lend 20% of mortgages, and as you know, the biggest transmission mechanism in this country, not true in other countries, is from interest rates through mortgages, crowding out discretionary investment. I have the best data in the country on that. I have 50% of the adults and 25% of the payments and transactional activity in the UK go through our big data environment. So I'm advising the government on where cost of living is impacting society and how you have targeted support to prevent and support vulnerable customers, and how to make some of the fiscal stimulus more effective. This is all at the core of economic theory. Fairness, economic theory, inequality, and then how you make the outcomes better for society, whatever the objectives are, whoever I'm talking to, red or blue in this context. That's what you have as a role as in financial services to play a role around. And if I didn't have the learning from Cambridge, I'd feel very, very exposed in those conversations. Now, second thing, how do you get match fit? How do you get match fit? So we hire about 200 graduates a year. My last organisation, we hired about 500 graduates a year. The very first thing that virtually all of them, we were talking about this just before I started, that people get surprised by is within our first 2-week induction, at some stage, kind of 50, 60% of the way through, when you're being asked to start work at 8 a.m. for the 7th day in a row, you get about 10 or 20% of people that stop showing up. And the first shock is, are you really going to expect me for the next 30 years of my life to get up at 8 a.m. or get into the thing and work for 10, 12, 14 hours? And the reality is, probably yes. I'll come back to how hard you have to work. And I'm not sure you can do much to prepare for it. But I do think that's why doing something that you have a genuine passion for is by far the most important thing. And hopefully if you're as dull as me and you're passionate about my 3 things, technology disruption, financial services, and seeing the world and working in different cultures, it's pretty easy actually to get passionate about what you're doing. But that's the first thing that's really important, your expectations around what you're going to be expected to do. The second thing which people always tell me is a lot of people feel they need to play a certain role, they need to be a certain way, they need to sharpen a certain level of professionalism, which isn't really themselves. I think that was true 30 years ago. My strong advice or perspective would be get comfortable showing up as your authentic self. You'll have much more impact. People will follow you or want to work with you, and it will be far less tiring to spend 12 or 14 hours a day. I spent my first 10 years playing the role that I thought I needed to be. The other thing that will make you smile, because it's not true anymore, I looked very young when I was younger, not as young as you, obviously. But I had this huge issue, which is I was in with CEOs and boards being paid thousands of pounds a day at Accenture and McKinsey's providing advice, and I looked like a 12-year-old. So I felt I really had to play a role. The reality was that's just a distraction. It's not the best way to be impactful. So get comfortable being your authentic self and make it work for you.
And in fact, that almost ties into really the next question that we've had emailed in terms of, well, you touched on it there, of 30 years working a 10-hour day. It doesn't sound particularly attractive. Jessica asks, how do you maintain a good work-life balance? I'm going to ask you this question personally because you must be very, very busy and running such a big organisation, but equally, how do you ensure all the staff at Lloyds, even if it's down to that 18-year-old person who's just joined in the mailroom and all the way up to the top, how do you ensure everybody has a good work-life balance?
So now you've asked that question in a way that I can't answer it with 100% certainty. Look, the starting point is I have worked hard. By the way, I have a family with four children, and I still get to do what I care about passionately, which is exercise 4 or 5 times a week. The reality is you're going to have to work hard depending on your career choice and what you want to do. However, I think I've worked less hard than virtually anyone else within my peer group. So I've never done an all-nighter, which makes me smile. If you're a consultant, you wear that as a badge of honor. How many all-nighters you've done. I decided very early on that wasn't something I was interested in doing. So you can set your own boundaries for a start. And the second thing is, which I think is great, and maybe something I want to talk more about, is the hybrid flexible ways of working that society is getting comfortable with post-COVID, and the ways of working that technology is enabling is creating much more flexibility for our people and for balance in terms of what we do. For what it's worth, because Lloyds Banking is more of a real economy bank that serves real customers and less of a trading investment bank, the average working hours are much, much more aligned with the rest of society. I think the really hard working hours are in kind of complex trading environments. Or when I was based in Hong Kong for 5 years running 45 countries, if you're in the wrong time zone running a global organization, it's just tough, right? The only way I could get my whole team together was at 10 p.m. at night because I had Argentina and Mexico and US and Canada and UK and France and the Middle East and China and Australia. You could only do that at 10 p.m. at night. But this is about doing something you're passionate about, define your boundaries, and then don't go and do a job that's really stupid, like a trading job that makes you work 20 hours a day.
And in fact, we've got many, many more questions, and thank you to everybody who's emailed in some very good questions in terms of work-life balance and careers and how to get on in the finance industry. I'm aware that time is pressing because I know everybody wants to get to the cheese and wine before it gets to midnight, so I'll actually move on just a little bit quickly now, and we've briefly touched on macroeconomic issues, but I do have to ask you right now, very turbulent time on the markets. We had, after all, there was a mini budget, or rather a fiscal event, as we were being told that it was being called. 3 prime ministers this year, who would actually believe it? Base rate up by 0.75%, now suddenly 3%. Hang on, historically, I'd have said the Bank of England should be keeping it between 2 and 3%, so historically it's not that big. But anyway, we've had some quite big financial shocks this year. What are your thoughts on the broader macroeconomic outlook?
Shall I say UK or shall I go global?
Let's go UK to start with,
UK.
and then expand it globally.
So the fun thing, and hopefully you're seeing this, every theory that you ever thought you were ever going to want to test in economics has happened in the last 3 or 4 years. I mean, when I was studying, the liquidity trap and negative interest rates was a theoretical concept, which I then got to live through for 10 years. I mean, it's just amazing. Anything that you could ever have wanted has happened, which is just brilliant. And it is worth just admiring some of the things. So what happened, I'll give you one more example of that before I answer the question fully. What happened 3 or 4 weeks ago with the Kamikaze budget, let's call it that, was a fall in the value of gilts, 50-year plus gilts, by between 50 and 66%. So a complete loss of confidence in the UK and the UK's ability to generate taxes to pay off its debts, and a collapse in the value of the asset that the UK issues by 50 to 66%. This is I say it with a smile, the risk-free asset that is the basis on which we calculate the value of all other assets. So just brilliant volatility, and it's fun, actually, to be in the middle of it and understand what's going on and be advising the governments and the Bank of England or giving a perspective around it. Look, there's 2 parts to this which are really interesting and seem counterintuitive. The first is, as we know through the last 2 years of COVID, the big shift that happened was a massive move away from household and corporate debt to government debt. And actually, households and corporates are on average, and I think that's the worst expression I could possibly use, so apologies, but you'll all get it. I think averages are terribly misleading. But anyway, on average, households and corporates are actually in a pretty strong place today. And even today, with all of what you read in the press, and I can show you the facts to support this, households and individuals, 70 to 80% of them are telling us they're genuinely worried about COVID. 20% are having to take tough choices to stop discretionary spending to make space for energy, food and fuel. It's actually only 1% that can't make ends meet, and 80% of them couldn't make ends meet pre the current cost of living crisis. Now, if you listen to the press, it'll make you believe that 50 to 70% of society isn't working, and society has £200 billion more savings, 10% of the economy, £200 billion more savings in their current accounts than they had pre-COVID. By the way, £70 billion of that came to Lloyds Banking Group, so we're flush liquidity. So don't worry about our stability. The same is true on corporates. I can show you all the stats around. They've got lower working capital accounts, they've got more cash on average, and they've realigned their positions and their cost bases. There's definitely corporates that are really struggling, but on average, that's what's happened. So we enter this crisis with a stronger cash flow and balance sheet in households and corporates, and with unemployment at 3.7%. Now, you must have had a laugh to admire how available hours has declined, about 2.5% relative to the trajectory. That's a huge issue for the UK. But actually, unemployment is in rude health in the UK. We've never been in a recession that looks like this. Now, what's going to happen is difficult. We don't know. We'll see what the autumn statement says next year. I'll give you the numbers that we've projected. We're projecting a 1% fall in GDP next year, unemployment going up to 5.5% by Q1 2025, house prices, which are particularly important in this economy, falling by 8%, and interest rates rising to 4%. I think the yield curve, which is saying interest rates will go to 5.5%, will only happen through a complex dynamic between the government's fiscal policy being clumsy or Powell and the Fed driving US rates more aggressively high, which will come back on the UK through a pressure on the exchange rate. So our baseline is what I just described to you. It's a shallow recession, but without unemployment really being at a scary level. And that's where you get real inequity and real stress on an economy and societies and communities, is when unemployment jumps up to 10%. We don't see that at the moment.
And in historical terms, it's almost a benign set of circumstances. Let's look at this. All right, if base rates go up to 4%, historically they've been far higher. Equally, okay, we've got CPI at 10% at the moment, but chances are it may go down a bit. The only one that would probably scare people in there where you're talking about house prices falling by 8%. So if it's actually so benign, it almost looks as if this may actually be over quite quickly. Today we had the US inflation figures out. They're out a couple of hours ago, and it's already fallen down to 7%, so it's almost coming down to historical levels. Do you think then, in this country, when it comes to economics, we have some of the media who are almost as economically unliterate as the previous government we had for a few weeks?
Oh, I love that question. And not what I'm going to answer on the camera and the answer where you want me to. So what I'll say is I've had to become very comfortable talking to the media, and look, the media does what it's paid to do. It's paid for clicks or for people who are going to buy papers, and human behavior is really, really clear in this. People like bad news, not good news. So the media will always take the extreme view. I don't blame the media on this at all. What I've been doing through my media and then through my government intervention is trying to get a slightly more balanced narrative. And the narrative I used over the summer was we're at risk of talking ourselves into a recession. And the thing that really has frustrated me through this period today and actually looking into the future is two things. One is, as I said, there's 1% and it'll become 2%, 3%, 4% of people at the lowest income percentile that are genuinely making decisions that I don't want people to have to make living in this society. I've worked in most societies in the world, most of the major societies, and it's a different stance, but choosing between heating and eating is genuinely a decision that we shouldn't be tolerating in UK society given the wealth of this society, and we're not being anywhere near supportive enough in a targeted enough way around those customers. The second thing, which drives me nuts, is the real issue for us is about our medium-term ability to generate jobs, productivity and growth. We can have a discussion around growth and sustainability. I'd love to get to there because I do believe you can square the circle on that. But the UK has had an incredibly poor decade, and I don't worry so much about slow GDP growth in the next 1 or 2 years. I worry much more about an increase in inequality, no investment or building of industries and sectors where we're going to generate the medium to long-term growth in this economy. And when you look at our position in the world, our balance of trade is very negative. Our fiscal and government debt position is very, very challenging. And I see no direction and I see no focus around building long-term sustainable productivity and growth. So short term, let's get a lot more real about helping vulnerable customers. The media is being way too soft, and our policy framework needs to go after supporting customers. And let's get really focused on building genuine employment, productivity, based on the back of IP in sectors, in parts of the country, which we can then really get behind. And that's what I'm focused on doing.
Absolutely. We've got a load more questions, actually, macroeconomic questions, which we may not get time to go through, because I equally want questions from the floor in about 10 or 15 minutes, so get ready with those questions. But I do have to ask you, you're talking there about financial inequality, and particularly in communities. I'm sorry, I'm going to put you on the spot here. Lloyds closed 66 bank branches last year, and it left some communities with quite a long way to go to physically go into a branch. I know a few people do now, but a few people do actually like to bank in person. Indeed, Cherry Yang asks, financial inequality, it's obviously a real issue, and Adam asks as well, and thank you for this, and I'll pose it to you as a direct question. How do we turn financial inequality in communities around? What can we directly do?
Great. I won't give you the sales pitch, by the way, if that's right, but I'll just give you some of the facts around it. It's a real issue, and I think of financial inequality and I think of vulnerability. They tend to be very, very overlapping. So the people who use branches tend to be vulnerable in some way, and vulnerable in financial services, just before you worry about inclusion, has got it's got a strong regulatory tinge to it, and I'll just give that to you. It's temporal vulnerability as well as vulnerabilities that are persistent. So older age people, people whose English language isn't first language isn't English, people with mental health issues, people who are made unemployed, people who are going through a bereavement. All of those are called vulnerabilities, and we have a massive amount of focus on that. But interestingly, vulnerable people tend to be the ones that are most in need of face-to-face services in branches, whereas when I look at the 26 million, we actually have 38 million customers, but 26 million actively engaged with us, half the adults in the UK, 96.3% of everything they do with us, they do digitally. And that's the starting point for this. Lloyds Banking Group, we have 15 million people logging on at least 30 times a month with an NPS of plus 70 on our digital services. It's the biggest actively engaged digital service in the UK, interestingly. There is social media. You have to go to Facebook and WhatsApp to get bigger. Twitter is at 14.7 million. It's going down, I think. Netflix has got 9.7 million users. So we have 15 million people that we can serve up services to, interact with, and then increasingly, which is what I'm building, I'm using digital and AI to start to use nudge behavioral economics to drive better outcomes for customers. So the starting point is, how do people actually interact with us? Digital first. The second biggest channel is telephony, and increasingly voice, live chat, so natural language, two-way text messaging, and then Skype or videoing. And then the third is branches. So branches is really important. The second thing is branches usage has declined 30% in the last 2 years and 5% a year for the last 20 years. And so we have to do what our customers are asking us. And my response to that is, if we do take a decision to close a branch, we need to work out how you meet the needs that you can't do physically. So we have post offices, we have ATMs, and actually I just set up, since I came here in the last 14 months, something called banking hubs. So we're setting up a company, we've opened 10 of them so far, and they will provide services for all the banks in the communities we exit. Now the sales pitch, by the way, is Lloyds Banking Group has 1,500 branches. It's 3 times the size of the next biggest branch network in the UK. And we have, and since I've been here, we have continued to have by far the biggest investment per customer in branch networks. So one of the things that makes me smile when I get beaten up around this, which I do regularly, by the way, is HSBC, who I left, had 450 branches. NatWest has 500 branches. The government-owned bank, so social purpose government-owned, it went from 1,200 branches to 500 branches in the last 5 years. So, from a relativity basis, I feel pretty confident about where we are. The more important thing is how we actually help vulnerable customers, as you say, and this needs to evolve. And what's brilliant, I am at the level now where, based on the data and the insights I have, I can start to personalize the experience for each individual, and I can start to, if you give me permission, track outcomes, not inputs, and then start to provide advice. And that we're going to start switching that service on more and more, but that's going to become fundamental to building the future of financial services. By the way, I've been doing that for a decade in China, Singapore, US, Australia, Mexico, Brazil. It's the UK that's about 10 years behind, and that's what we're going to transform.
I will come to questions from the audience in just a moment. I'm sure you've got many more questions on that, but and we've had some real thorny questions emailed in before this, and I hope you don't mind a rather thorny question. Now, of course, Lloyd's got a lot of good headlines for ditching finance, for new oil and gas fields. So, Tara, thank you for
We're the only bank that has said we're not going to finance new oil and gas.
Exactly.
And we'll be out of coal this year. Actually, the government's just changed its policy on that, but anyway.
But Adam, and thank you again for asking the thorny question, says, well, if we're investing in companies that aren't green, isn't it time to really just step away from, say, all investment in oil, all investment in fossil fuels?
Yeah, so actually I'm really pleased this came up. So this is something I'm, obviously very passionate about. I've committed Lloyds Banking Group to reducing our financed emissions by 50% by 2030. By the way, I don't think society will get there, so I might miss that, but I'm fully committed to trying to accelerate society, the government, and then all of the private enterprise. There's a few things I've learned. I've been running at this for the last 15 years of my life, and I've done it on a global platform through HSBC, which is a much harder platform because Saudi Aramco, for example, was the biggest client of HSBC, and I've done it now in a UK-centered perspective. Look, the first thing is there is no binary answer on this. If you just say, and I could, the easiest decision for me would be to say, I'm only going to finance green companies. And I say that deliberately that way because, by the way, there is no consistent definition of what a green company is. If I did that, I could finance 5% of society. The vast majority of society and companies are grey or considered to be big emitters. So the first thing is you can't actually fulfill your purpose. My purpose of Lloyds is helping Britain prosper. I couldn't actually do that if I decided to switch off anyone that was not considered to be 100% green. So that's the first thing you have to get your head around. Enabling the transition is to enable companies that today aren't considered green to become green. The second part of the discussion, which is a really interesting debate, and hopefully you're having this, is even if you assumed, let's assume you wanted to, let's take BP and Shell because they're the easy ones, and I know Ben and Bernard, the CEOs, very well. Even if you said we didn't want those companies to exist, and we're going to create 2 new Amazon startups who are going to replace the energy system, and we'll demise BP and Shell, and we'll have some new startups that will do this with green energy only, and ignore the fact that green energy can't meet our needs and we don't have storage for our energy and nuclear will take too long. Ignore it. Just assume you could wave a wand and deal with that and say, we're just going to go solar and wind. You couldn't create the energy infrastructure by 2050 to replace what Shell and BP do, even if you had all the financing in the world. The second thing is Shell generates about 70 billion of free cash flows a year, and they're investing 50 billion in the transition. The government won't do that, and there is no other financing. So we need these grey industries or dirty industries to lead the transition, and my job is to identify and put pressure on those oil and gas companies and work out who have what we call credible transition plans. The third part to this, which was particularly relevant to my last job, if we forced BP and Shell out of business, which has been a whole debate that's been had, but let's just go with that as a hypothesis, the world, including most scientists in the UK, believe oil and gas production will peak in the early 2030s. I know the companies that will then fill the demand. It'll be Russian, Middle Eastern, Saudi Aramco, Latin American and Chinese firms, and none of them will be Western democratically governed. Now, I am a massive supporter of non-Westernly democratically governed governments. I had 40,000 people in China, we were just talking about it, so there's no judgment on that. But let's be clear, the judgment that's being applied around oil and gas is typically coming from a Western democratic investor perspective. And the world would be a far less stable place. We know what energy security has driven through the 70s, 80s, and 90s. You can go through whichever Middle Eastern war you want to talk about, driven on the back of energy security. The world would be a far less stable place if there wasn't balance in our production and our ability to own the transition. Now, people aren't willing to have this debate. The reason I was comfortable in the UK, taking a leading stance as Lloyds Banking Group, is I don't need to force impossible decisions. We in the UK can only fund green energy because the energy transition in the UK is a much, much easier problem to solve. When I wrote the policy with the CEO of HSBC for energy, oil and gas, I'll give you an example of this, we decided to allow HSBC to continue to consider, this was in 2018, financing coal power stations in Vietnam and Indonesia, I think it was. And the reason was, we knew, and we'd been told by experts, they didn't have alternative ways of generating electricity. And if we excluded them from the financial system, we were excluding tens of millions of people from economic development. So, I won't carry on with this, but the important point for me, I think, is these are the real judgment calls. The fun thing about economics and financial services, by the way, is if you want to go and start trying to solve these issues and work out how to enable societies and industries to transition, that's at the core of what I'm doing and what we're trying to do. But you have to be comfortable dealing with grey. You can't assume the world is binary. And anyone that does is just avoiding the big issues. By the way, that's not to denigrate the NGOs. We need members of society challenging us really aggressively and holding us up to account. And I, by the way, I get it, right? So I get the NGOs on my doorstep the whole time. And that's a really important role. But if you just stay for a second and say, how do you transition the world economy and the world energy supply? By the way, we haven't talked about the 3 hard-to-transition sectors, which are agriculture, transport, and the built environment, which is where I'm very focused as well. Then you have to have a much more nuanced view around how you enable that to happen. And yes, you have to be willing to say, we will exclude things from the financial system, and we will make judgment calls around what we stop. But you have to have an answer for how you're actually going to enable the transition to occur.
And we do indeed have many more questions about ESG and ethnically questionable companies, but I'm acutely aware of time because the cheese is getting warm and the wine is getting cold, or probably the other way around actually. So we've got time for questions from the floor. So if anybody wants to ask a question, we have a roving microphone over there, which Sally can toss to you. But please do put up your hand if you've got some questions, and indeed if you could also say who you are and your college as well, if you could, that would be great. So please, ask away. Questions from the floor, hands up please. And hurrah, we have a question. Good. Now, can we get a microphone to you?
Hi, I am Jean Bor from Clare College and I'm studying MPhil Economics. And you were talking briefly about macroeconomic trends and housing markets in the UK. And I'm just wondering, do you think housing is ever going to be more affordable for new time buyers?
Gosh, do you know, if you'd asked me in 1990 when I first thought about buying a flat, I told you house prices were overpriced. Then I said the same in 2000s, and I said the same in 2010. And house prices have gone up 24% since COVID started, on average in the UK. So, look, I think there's a couple of thoughts around it. You know the UK is an unusual market in that inherently supply is constrained. We think we need about 250 to 350,000 new houses a year to actually meet demand. Less than 150,000 houses are being built, so the supply problem is getting worse. And there's about 26 million bedrooms which are either in secondary homes or unused. So there's a massive part of the housing stock which is underutilized in the UK. And obviously, it's been a destination site for international people to buy housing. In fact, my last organization, that was one of my core propositions, helping Chinese and Asians buy housing in the UK. I didn't facilitate Russians before you go there. But those dynamics mean housing in the UK is a very robust supply and demand situation. Having said that, as you know, the average income to house price has got to 7.5 times. And we thought 5.5 times was probably a limit that would be hard to get past. And what's happened is the average income of a mortgage owner in the UK has increased. So again, I have 20% share of the house market, and the average salary of someone who has a mortgage is £75,000. Remember, the average in the UK is about £32,000. So, and the average age of a first-time buyer is now in the late 30s. So what's happening is people are obviously using the bank of mum and dad for their deposit. They're waiting until they're in their late 30s, and they're buying houses later, which is enabling them to buy more expensive houses. So the demand construct hasn't reached a limit yet. If you take our view, do we think there's going to be a normalization back down in the next couple of years? There will be. But interestingly, because we saw house prices go up 25% from 2020, a 10% correction is still 15% higher than pre-COVID. And we don't see that materially collapsing at this stage. We do, for those that are interested, I do it in my quarterly results. I have a scenario that shows how house prices falling 50%, because I need to stress my bank against that. And I can show you what the economic consequences are, and I can show you the scenarios that drive that. But it's a really extreme scenario.
Very good question. I think if house prices do fall by 50%, then we'll be back into a sort of late 80s, 90s style recession with that. But anyway, more questions again, please, from the floor.
I have a follow-up for that. My name is Holger. I do economics too at King's. So I'm interested in how dependent the economy has become on low interest rates, right? So say the increases now will be persistent for a while. When the rates get that close to zero, the relative changes become very, very large, for an example, for mortgage holders. So, throughout the economy, if we've all grown too, used to very, very low interest rates, how bad can it get? And what's your take on that?
So the heart of this is the transmission mechanism on crowding out discretionary demand, right? That's what you're getting to, because that's the transmission mechanism you're worrying about. So it's really interesting, and it's very poorly understood. By the way, economists never want to have business people back, but one of the areas of economics I think that needs most fleshing out is how the transmission mechanism and financial services actually works, because I don't read a single economist's book that understands it. Now I run a bank. So that's not a criticism at all. And even they just, it's a, but it's a much murkier art. Even how interest rates crowd out other activities. It's not the deposits of the Bank of England that determine my interest rate. Interestingly, how I manage my balance sheet, $1 trillion balance sheet. So on the specific question, look, the first thing, just to be clear, is 95% of mortgages, new mortgages, there's a legacy book, are fixed. And they're now fixed about 60% 5-year and 40% 2-year. So let's just be clear, that's hedging, right? So Andrew is putting up interest rates, expecting it to crowd out spending through the mortgage. For the vast majority of people, it won't have an impact unless rates are still at that high when they remortgage in either 2 or 5 years. So the first thing is there's a massive mute on the transmission mechanism that we all think is going to have an impact. And it makes me smile. Just to give you a book, I've got £310 billion worth of mortgages. 55 billion are repricing next year. So it's a massive mute on the problem. The second thing, and I just talked about it, but I'll give you the data on that 55 billion that's repricing. Only £3 billion, less than 1% of the mortgage book. Remember, I've double the size of the next biggest mortgage bank in the UK. So only 3 billion, 1%, less than 1%, will take the income stress above 40% of the customer's income. So the interest they'll be paying will jump up to 40% of their income above. And that's our view behaviorally around when customers start to struggle and make difficult choices, which reduces aggregate demand. Now, there's everything in between, right? So there's people who are going from 20% to 30% of their income will be spent on interest. But because in the last decade post the financial crisis, the affordability and the cost of getting a mortgage has got so much harder, it's largely now a problem for relatively wealthier people. And as we know, relatively wealthier people have a lower percentage of their income that they spend, so the spend effect is more muted already, and they've hedged interest rates for 2 to 5 years. So there's definitely an impact, but I think governments and central banks have misunderstood, and that's not hard to understand, the simple dynamics by which this runs through the economy. I think there's much more direct transmission mechanisms around how people think about risk-free rates, about crowding out investment, and around returns that have a more immediate impact and will slow down the economy than actually the transmission mechanisms through mortgages crowding out discretionary demand. Does that make sense?
I mean, yeah, it does. I'm just more interested in the longer term effect. So I'm not going to sit here and say that interest rates are going back to 20%.
Oh, they're going to go back to 2 or 3%.
The next 40 years, right? But I mean, during the last 40 years, they've mainly gone one way, and it's just interesting to me to see like how much of people's net worth can get wiped out in, say, the real estate market if, like, over the next 10 years, when all of your mortgages will be refinanced, the rate is consistently at 5%.
Yeah. So our view is, I think that's where you're going, and for a more complex set of reasons around supply chains being re-engineered, that inflation will stay more like at 2%, won't go back down to 0. We can have that debate, but that's around the global supply chains and the role that China's played in the last 30 years, which is not going to be repeated. And on the back of that, interest rates are going to be more 2%-ish, let's say in the medium term, and I say medium term, 3 to 7 years, and not back down at 0%. And then you have to look at, as you say, what's the drag on people's incomes. I get to the same answer, and I can tell you the answers in terms of hundreds of pounds a month, because the income of people that have a mortgage is still relatively high, and they have high savings. It doesn't necessarily reduce the aggregate demand in the economy, if that's what you're worried about. And it's all linked to the fact a lot of people in society, not us, but politicians and central banks in the UK, and the UK is very unusual, as you know, still are believing that the people who own houses are the Thatcher era that bought their council house. So it's lower income people who own houses with high debt to income ratios. The reality is, post the financial crisis, there are some of those left, but the vast majority of people, I'll use the data point again, £75,000 is the average salary of a mortgage holder in the UK. I said I hate averages, but it's a very, very high income level if you understand distribution curves around incomes. And the average savings of those customers is in the tens of thousands of pounds. So, as in they're not using their free income to create aggregate demand already. So it's definitely going to have shocks. It's definitely going to have squeezes around the edges, and there are some customers that have a difficult transition. But I'm far less worried about that, actually, than I am fundamentally around whether we get any kind of sectors and industries which are driving growth and productivity and jobs, both domestically and then competitively, which I think is by far the biggest structural issue for the UK. It has been for 30 years, but some of the sectors, financial services is the powerhouse, right, of economic and growth, and from a services perspective. And even that has been shrinking for lots of reasons we can talk about. So even the areas which are sources of competitive advantage are not healthy today. And then when you look at new sources of industries and growth, there is very, very limited investment and focus on driving medium-term growth in those sectors. And I think for me, that's a bigger issue than the drag of a higher interest rate environment on the UK economy. But yeah, sorry, so I didn't get the medium-term nature of it. Great question.
Absolutely, and 20 years ago or so ago, we'd have interest rates as a crude lever you could speed up or slow down the economy. We've moved on a bit now. Interest rates are no longer that sort of brick on a piece of elastic that you tighten it too much and then hit you in the face and you get a recession. We've moved on. But sorry, no, that's a separate issue. We've got time. Maybe let's see if we can squeeze in 2 more questions. I know everybody is desperate to get to the wine. Do we have another question from the back? Yes, please do.
So I'm Adam, primarily here from Boycott Banks Destruction, so the last final question on there was sent in from myself. And just to come back on some of the things you said. So for example, first of all, you mentioned that you were one of the first banks. There is a question at the end of this. That you mentioned one of the first banks, you were the first bank to drop new oil and gas and fossil fuel funding in the UK. Whereas in reality, that's, as you know, it's project finance, and that really only accounts for, among European banks, 8% of all the banks' funding of new fossil fuel projects. The rest comes through other finance. So question number 1 is how do you wrestle with that, whereas you say you can't withdraw all the funding, and yet you're still funding new fossil fuel projects that will take us over catastrophic limits. I mean, some of you have the leaflets here today with the image of the burning forest. That's a reality. That's happening. So question number 1 is, how do you wrestle with that? Question number 2, in terms of specific green funding, you look at, say, HSBC's policy, which you mentioned, has now recently been called up for actually going to fossil fuel projects. So their green funding they committed went on things like oil pipelines, for example. And they've been pulled up for that, quite rightly, on their advertising. And, so how do you ensure your green funding that you say is green funding is going to the right places if it's still going to fossil fuel companies that have lied time and time again? Isn't it time you left them wholesale? Because your money, our money, if you bank with Lloyds, is still going on those projects. And lastly, coming back to your equality and diversity commitments, some of you may not know, but today is the anniversary of the death of the Ogoni 9 for defending the Ogoni land from Shell's oil expansion. So they were executed essentially on Shell's behest. So you say you have these lovely equality and diversity figures, and yet you're still funding these companies across the world that are committing genuine atrocities against ethnic minorities and indigenous minorities. So how do you wrestle morally? How do you justify that is my question to you.
Great. So thank you for asking the question, and thank you for trying to get to it. So some of your facts are wrong, but largely I think the tone of your question is right. What you're talking about is something called an RCF, which is a revolving credit facility, which is something you have to make available to a corporate to be allowed to enter into providing other services. And you can't specify what the revolving credit facility is used for. So if you want to finance, we're the biggest financer of the wind farms in the UK and in Europe. If you want to finance the wind farms that EDF and Shell, or the hydrogen farm that Shell is building, hydrogen factory, you have to offer a limited amount of what's called an RCF, and that's what you're talking about. It's nowhere near only 8%, but it doesn't matter. The spirit of it's still right. You can put some constraints around that, but you can't completely limit it. So the answer, and I said it gets you unfortunately into these difficult questions which you're avoiding in the way you've asked the question, is my answer to that is you have to decide which organizations have a credible transition plan, and that's what we call it, a CTP. And you have to decide which of them you're willing to try and invest in to enable us to make the transition, that have the right values and culture and ethical standards that you think you can support, fully recognizing that no organization that's going to make a meaningful difference to the world is going to meet all of your standards, right? So that's the starting point. If we exclude all of these organizations from the financial system, society will fail. So one of my questions when people ask me the question that way is, what's your alternative for energy production in the globe if you want to make these organizations fail? We have, by the way, excluded the vast majority of oil and gas. So I'm a very small oil and gas financer. I didn't give you the numbers, but it's less than 0.5% of my $1 trillion is in oil and gas at all. But I don't try and talk about that because I still deal with the ethical issue around why do I finance anybody? Why don't I just pull out, to your point? So you have to make the judgment call around, unfortunately, the way the markets work. You have to do some financing to get to do the stuff you want, which you called project finance. It's slightly more complex than that because there's lots of different ways of providing the financing, but the judgment call is right. And for me, I need to be comfortable that we have a process and due diligence, we talked about it, where I can stand by why I think this firm does make sense. Let me give you a more complex one. I won't give you the name of the firm, but you'll be able to work it out pretty quickly. The biggest financer of wind farms and green energy in the UK is a German company. The challenge in Germany is, German society decided against nuclear power a long time ago, and they still use coal for producing a lot of their energy. So that's a real choice for me. They are the biggest financer and investor in genuinely sustainable green energy in this country, but I have to offer them a financing facility that they could potentially use to maintain, they're not opening any new coal plants in Germany, to maintain coal plants in Germany. And I've made a statement that I'll be out of coal completely. I initially stated this year because there's two coal plants left in the UK. The UK government just changed its stance post-Ukraine and said they're going to continue to allow them to operate till next year. But I'll be out of them by next year. So that's a really difficult choice, right? So you can work out the company, but do I finance that company at all, which I think is a big part of helping the UK transition to net zero? Or do I say I'm excluding you from my financing as the biggest financer in the UK? And we've made tough choices where we've excluded the vast majority of firms. If I decide to sit on the sidelines and exclude all of them, either they will fail and society will fail, or alternatively, the firms that will finance them won't have the same standards. And so, I love the way you asked the question because it's the way I get asked the question from the NGOs, and it's the right tension to put into my debate. But then my question is, let's work out who's actually going to make society transition and who's going to take those tough decisions, because you need to lean into the tough decisions, not just assume the world is as simple and binary as you just laid out.
Can I come back?
Yeah, please.
On that? So for reference there, so BP, Shell, most of us, RWE, which is a particularly one of the big ones, don't have credible transition plans. They simply do not have them. So what you're saying is wonderful. We love it if they had credible transition plans, but they simply haven't laid it on the table. A portion for funding, which is, like you say, it's big compared to everybody else. But at the same time, their proportion for funding is tiny of what they actually produce. They're still running on oil and gas. And lastly is, you don't have an end date for when you will pull out for the new fossil fuel projects. So why haven't you say, fine, it's not possible now? I take your point. We can argue to the cows come home on that. But when does it become possible? When do you step back? When do you provide that incentive, say, for 5 years' time, maybe longer, are you saying we need credible transition? Because they don't have it.
Yeah. So, and again, this is a really important debate, and hopefully you have a chance to talk about these themes, because this, for me, is the most important part of the next 15, 20 years. The starting point is, let's just be blunt. Society doesn't have a credible transition plan in the world. The UK, which is one of the leaders, doesn't have a credible transition plan. By the way, the highest emitting sectors are actually agriculture, transport, and the built environment. The energy sector has a far more credible transition plan in this society than those three sectors. So I love oil and gas, and I love the fact people have energy about it. I've got £310 billion of property in built environment, which is a much more complex problem. I've got less than 1% of my $1 trillion against energy. So there's far bigger problems to solve, and there aren't credible transition plans for any of them. So the starting point is, do you want to avoid that as the issue, you're taking me one level higher. I'd go to a much more fundamental level and say, if you want to get society, including governments and then large corporates focused on this issue, what's the best way of forcing that? And so my stance on that at the moment is pick people and organizations I think are committed. I know they haven't got credible transition plans because our society doesn't have credible transition plans. They can't push a piece of string uphill, right? A bit water uphill or push a piece of string. And then commit yourself to helping them flesh out their credible transition plans. For what it's worth, I committed to 50% reduced financing by 2030. I've gone through sector by sector, and I know I can't fully meet that. I'll give you my favorite one. The government's own plan for achieving our agricultural transition assumes we will all stop eating 60% of meat by 2030. So we just, society doesn't at the moment seem to be going down that path. There's no policy framework, there's no incentive framework, and I can't stop you all eating meat. But I can't stop financing the agricultural sector because I think producing food in the UK is quite important, to say the least. So you have to go up to the highest level, and you have to work out where you want to lean in. And I've decided I want to lean into making the transition happen. And you have to take some difficult judgment calls. But what I love about what you're doing is exposing the real challenges which still are evident bluntly at the highest levels of the problem statement you want to lay out. But you have to recognize it's not Shell. We can talk about Ben's the CEO of Shell, he's leaving, but Shell, all companies have issues. Shell has issues. But the world, and then the UK at the highest level, doesn't have a credible transition plan. And then when you get within specific sectors and or government policy areas, they don't yet have credible transition plans. And then when you hold individual firms accountable, to then hold them accountable for not having society's transition plan becomes much more challenging. So you need to work out how you're going to unlock that problem and where you're going to lean in to start to make a positive difference rather than making statements that won't help. So I love the challenge. And I really think you're on the right track, but I would ask you to just keep thinking about where do you really lean into the problem. I've worked with a lot of scientists, and I spend a lot of time looking at these charts. As I said earlier, the best charts show that oil and gas production doesn't peak until the end of this decade. Now, the scenarios where it does typically have a very unjust transition. And our purpose statement of helping Britain prosper, I've then put a mission statement beneath it, which is I'm committed to building inclusive and sustainable growth for people and businesses in the UK. The reason I did that is inclusive is as important as sustainable, and I can do that at every micro or macro level you want. There isn't a transition pathway I've seen from any NGO or scientist that doesn't recognize that oil and gas is a really critical part of the transition, and actually production peaks in the future, not today. And that is with a very unclear, just part to the transition. Any pathway that's more aggressive, you have to start making incredibly painful decisions on both parts of the world and countries, and then members of society that are going to have to go backwards. So again, you decide what you all individually want to do, but don't talk about transition without talking about a just transition, and think about what inclusion means. I'll give you a very simple example, just to move away from oil and gas. There are a number of people in the UK that are saying on home transition in the UK, which is a particularly difficult challenge, it's about 17% of emissions, we've got a very old housing stock. We should create incentives for people that have an EPC rating, which is about the energy efficiency of the home, above C. The majority of people whose homes aren't energy efficient at C are lower income people. So I'm going to start offering cheap financing or exclude them from financing or exclude them from being able to do retrofits at a lower price point because their home is less efficient today. There is other major providers in the UK that have made that explicitly their statement, and I've said I'm not prepared to do that. Actually, I announced today, you've seen it, I've just done a deal with Octopus where we're paying £1,000 to people to try and fund their own heat pump and retrofit alongside the £5,000 from the government and trying to build turnkey solutions, and I'm targeting that at lower income families. And I'm the biggest financer of social greening of housing with the government in the UK. We put 12.5 billion against it. Because if you don't look at inclusion and fairness, a just transition, you get into a very sticky place very quickly. Anyway.
Okay, I'm talking of timelines. I'm acutely aware that time is going on and everybody wants to get to...
Julian? I was just going to say, if we're going to take one last question, I would like it from a female, because Charlie told us 47% of his direct reports are now female. And if you want that job someday, now's the time. You have to start asking questions. So,
hi, I'm Amy, female. I'm studying at Clare College, and my question, well, I was quite interested to hear what you had to say about, well, A, just kind of what your role involves in terms of advisory of the government. And maybe this could be answered by kind of understanding the breakdowns of revenue, what comes from kind of, I guess, interest on risky people, and then growth, because you spoke a lot about growth and productivity and all these being kind of key questions, and I think we all agree. But I guess my question is kind of, why should I believe you when you tell me that you care about vulnerable people, in the sense of kind of not vulnerable as you kind of described as like a regulatory thing, but as people who, you know, can't pay back, and you're making money off that?
Yeah, well, great, and it's not the perception that people have of banking, right? So where the way banking was positioned post the financial crisis, I haven't talked about the most informative parts of my career, which I was a consultant at that stage, but helping a few of the biggest banks in the world deal with the financial crisis was great. It was the best learning experience I had. Look, you know, what changes your beliefs is down to you personally. What changes my beliefs is looking at action and outcomes and what we're doing. But let me just start, because you went with borrowing, with a slightly painful reality of UK financial services, which is something I've inherited, but it is the reality. The people who are financially vulnerable, which I think you're saying is the lowest percentile people by income and wealth, probably. In the UK, that's probably what you're saying. I mean, vulnerability is much more complex than that, but let's just go with that definition. They don't borrow from the banks, because the banks learned through the financial crisis that if we did that, we would then be held accountable by society and by the government. The government changed the law to make payments back out retrospectively for products that society and the legal system had supported, to make repatriation payments. And Lloyds Banking Group paid out £25 billion on PPI, for example, over 8 years. So what's happened as a result of that is we bank all of those customers around payments and transactional and current accounts, and we provide lots of support around managing their finances and calculators and tools. But we have a very strict view around, we'll only lend to people that won't get into persistent debt positions. And I'll give you a couple of facts around that in a second, which is the challenging part of UK society. It's different than other societies. So we aren't lending to those customers. And what we do is provide support around financials. We provide lots of support and advice around planning. And then we fund, actually, charities, fund charities, which I've just ramped up another few £1 million into, to provide advice and real support to those customers. Now, at the same time, I use a lot of the data to understand what's going on. So my favourite one is, in the last 24 months, 18 months, people who've got universal credit into their account, i.e. on benefits, government benefits, have increased their use of buy now, pay later by 13 times. So that's an unregulated lending industry. There is 45% of those customers, sorry about the data, but you're all economists, so you can get it, who are what I call high-end BNPL users, and they're spending £2,500 a year, and on average they borrow for 3 or 4 months. So they're borrowing £600 to £700 from an unregulated digital fintech that has no credit standards and no focus on outcomes. So one of the things I have to do in my bank, I don't lend to these people because I know that they couldn't deal with persistent debt. I'm trying to support them in other ways. I'm also trying to work out which parts of the system which aren't regulated and aren't focused on outcomes are exposing them to risk, and then trying to help give them advice to manage those outcomes. It's a really interesting dynamic in UK society, because the UK took a very clear, simple view, which is fully understandable. I wasn't a banker at that stage, post the financial crisis, that's changed who lends to the most vulnerable people financially, and it's not the high street banks. However, we are trying to work out how we help those customers despite the fact that we didn't lend to them. The only thing that will change your belief, I think, is if you came and saw it for yourself and you sat with, I've got 4,000 people who are trained to deal with people in financial distress. It's called our CFA, Customers in Financial Assistance team. what they do, how they operate, the level of empathy and training, the investment I've put behind it. You'll never really see that. I don't expect anyone to ever thank a banker for anything, by the way. That's one of the themes, which is, choose what you want to get into. Thankfully, I'm much more focused on the outcome than I am about what people think about me. But that's the reality in this society. It's not the high street banks anymore that expose those most vulnerable people to unsustainable debt levels. However, it's a huge focus for us and a huge focus for how we build capabilities to try and support them. It's a much more complex issue, and we didn't get into my other passion, digital data, fintechs, and how we ensure good outcomes. It's a massive force for good if it were used properly. Unfortunately, what's happened in the last 30 years and 20 years since I was in San Francisco and doing the first stage of innovation is most of the fintechs don't have a framework for thinking about customer outcomes and or vulnerability. And it results in hugely bad outcomes for many of the most vulnerable customers. The whole cryptocurrency thing that's just blown up is a good example. But thank you, and I love the edgy questions at the end, so thank you for them.
Absolutely fantastic. I mean, I wish we could get to many, many more questions, and my apologies if I didn't get to yours, and I've got a lot more questions here. But of course, Charlie, you will be hanging around for the cheese and wine for a bit, won't you? So there will be an opportunity to talk to Charlie.
And thank you very much for showing up.
Yeah, fantastic. And that was Charlie Nunn, the Chief Executive of Lloyds Banking Group.